There is one question that haunts my comment section, floods my inbox, and even when shopping in the supermarket, it can often be brought up, Leo. I finally understand the home buying part, but now that I am stuck with this mortgage, what is the smarter move? Should I throw every spare dollar at paying it down, or should I be putting that money into the market instead? And honestly, I completely understand why this keeps people awake. You are lying in bed at 2 in the morning doing mental gymnastics, wondering if you are making a catastrophic mistake with your hard-earned cash. There is this massive mortgage looming over you, maybe $400,000, maybe $600,000, and every single month you are watching a painful chunk of your payment disappear straight into interest. Meanwhile, your cousin keeps texting you screenshots of his brokerage account gains like he is some kind of financial genius. It is maddening. I am Leo, and today I am going to walk you through this exact dilemma using actual numbers, real calculations, and a decision framework that finally makes this whole thing click. We're re-examining 3 distinct approaches, and I am introducing something I call the F-squared rule, which stands for the freedom fun rule. By the time we're done here, you'll have a crystal clear strategy tailored to your specific circumstances. If you've ever lost sleep over this mortgage versus investing question, smash that subscribe button and drop a like, because this one is going to change how you think about your money. Let us ground this in reality with a concrete example. You've purchased a home with a 30-year fixed mortgage. The loan balance sits at $500,000 with a 7% interest rate, which reflects pretty accurately where rates have been sitting in recent months. Your monthly payment comes out to roughly $327. That is purely principal and interest, not including property taxes, homeowners insurance, or any HOA dues, just the raw mortgage payment itself. Here is where our story gets interesting. Let's say you've been faithfully making these payments for 12 months, and then something wonderful happens. You land a promotion at work. Nice work. By the way, this promotion bumps your salary significantly, and suddenly you've got an extra $1,000 every month that wasn't there before. The million-dollar question, almost literally, is what do you do with it? Do you take that $1,000 and slam it against your mortgage principal every month? Or do you funnel it into the stock market through something like a low-cost index fund? That is the central puzzle we're resolving today. Let us examine the first approach, choosing investment over prepayment. You decide that rather than accelerating your mortgage payoff, you are going to invest that extra $1,000 monthly. You automate an investment into a total market index fund beginning in month 13, right after completing your first year of payments. Now we need realistic return expectations. Historically, the S&P 500 has delivered approximately 10% annually. When you zoom out over decades, individual years swing wildly, up 30% sometimes, down 25% others, but averaged across long time frames, you land somewhere around 10%. I am going to use 8.5% for our projections. This builds in a cushion for fees, potential taxes, and acknowledges that historical returns don't promise future performance. So you are investing $1,000 monthly at 8.5% expected returns. But let us make this even more realistic. Your income will probably grow over time. Let us assume you increase your investment contribution by 3% annually to reflect raises and inflation adjustments. Financial planners call this a step-up systematic investment plan. Running these calculations over 29 years, the remaining duration of your mortgage after that initial year, your investment portfolio grows to approximately $1,750,000. That is your comparison number. Burn it into your memory because everything else gets measured against it, nearly $1.75 million. That is serious wealth. That is early retirement territory. That is generational money. Looking at this alone, the choice seems obvious. Just invest and let compounding work its magic over 3 decades. But pump the brakes, we haven't to examine the other half of this equation yet. Before diving into our second approach, I need to explain something that most homeowners fundamentally misunderstand about how mortgages actually function. This might genuinely shock you if you've never encountered it before. Picture your loan as 10 equal blocks, each block representing $50,000 of your $500,000 mortgage. After making payments for an entire year, you've sent the bank over $39,000. Logic suggests your balance should be down around $460,000, right? You've knocked out nearly one whole block. Completely wrong. Your actual loan balance after 12 months of payments sits at $496,000. You've eliminated only $4,000 in principal. Where did the remaining $35,000 vanish to? Straight into the bank's pocket as interest. This mechanism is called amortization, and it is how virtually every American mortgage operates. During the early years of your loan, the overwhelming majority of each payment services interest, while only a sliver actually chips away at your principal balance. Let me illustrate with precise numbers from our 500,000 mortgage scenario. Your first month's payment of $33.27 breaks down like this. $29.17 goes to interest, while only $4.10 reduces principal. That is 88% interest, 12% principal. By month 12, you're still paying $28.94 toward interest and just $4.33 toward principal. Even 5 years deep, you're sending $27.10 to interest and merely $6.17 to principal. It takes until month 242, more than 20 years into your mortgage, before your payment finally tips toward more principal than interest. For 2 entire decades, you're essentially working as an unpaid employee for your lender. This explains why banks absolutely love 30-year mortgages. They're incredibly lucrative products. Now let's examine approach 2, aggressive prepayment. Understanding amortization mechanics. Let's see what unfolds when you direct that extra $1,000 monthly toward additional principal payments on your mortgage. Here is the beautiful reality of prepayment. Every single dollar attacks your principal directly. Unlike regular payments, where most evaporates into interest, prepayments deliver 100% principal reduction. When you shrink the principal, you shrink the total interest burden across your loan's entire lifespan. Let's crunch these numbers. You take your $500,000 mortgage at 7% and layer in an extra $1,000 payment starting month 13. We'll escalate this payment by 3% annually, identical to our investment scenario for apples. Apples comparison. The results are striking. Your mortgage, originally scheduled for 30 years, gets obliterated in just 16 years and 4 months. You've eliminated nearly 14 years of payments. Your total interest paid plummets from $695,000 down to $315,000. You've dodged $380,000 in interest charges. Many personal finance personalities would declare victory right here. See, they'd proclaim you saved $380,000. Prepaying obviously wins. But that is incomplete analysis, and it is intellectually lazy to compare things this way. We must account for the actual dollars you deployed to achieve this outcome. You made roughly 195 months of extra payments, beginning at $1,000 and climbing 3% yearly. Totaling those contributions, you invested approximately $235,000 in additional payments. Your true net savings equals $380,000 minus $235,000, which gives you $145,000 in genuine savings. But it is nowhere close to the $1.75 million from investing. At surface level, investing crushes prepayment by over $1 million. But hold on, we're missing one critical puzzle piece. Here is what nearly everyone overlooks in this analysis. When your mortgage disappears early, you don't just stop and twiddle your thumbs. Your entire mortgage payment, the original $33.27 plus the extra $1,000 you were contributing, suddenly becomes available. That is $43.27 monthly that you can now redirect into investments. Starting month 196, when your mortgage is completely eliminated, you begin investing that full amount. You still have approximately 13 and a half years remaining until we reach the 30-year mark from your original mortgage date. Let's calculate what happens investing $43.27 monthly for those remaining 165 months at our same 8.5% return assumption. This is where things get genuinely fascinating. 5 months at 8.5% annually compounds to approximately $1,120,000. Add back the $145,000 you saved in interest, and your grand total reaches $1,265,000. Let's summarize. Pure investing approach, $1,750,000. Prepay then invest approach, $1,265,000. Investing wins by roughly $485,000. Case closed, right? Dump everything into investments and ignore the mortgage entirely. Not quite. We need to discuss something called sequence of returns risk. This is where financial planning gets genuinely serious. And it is the factor that concerns me more than almost anything else in personal finance. Most people don't even realize this phenomenon exists. The stock market has averaged around 10% over extended periods. We've been using 8.5% conservatively. But here is the reality. You don't receive 8.5% like clockwork every single year. Some years deliver 28% gains. Other years deliver negative 37%. The order in which you experience these returns, the sequence, matters enormously to your actual outcome. Consider a concrete example. Suppose you began investing in September 2007, right before the financial crisis erupted. You invested $1,000 monthly consistently through 2008, 2009, and onward. Measuring your returns from September 2007 through September 2015, 8 full years of investing. Your annualized return landed around only 4%, even though long-term market averages run much higher. Now, imagine instead, you started investing in February 2009 at the crisis bottom. From February 2009 through February 2017, also 8 years. Your annualized return would have exceeded 16%, identical market, identical 8-year duration, dramatically different outcomes, based purely on timing. That is sequence of returns risk. Here is the crucial distinction. With mortgage prepayment, sequence risk vanishes entirely. Your interest rate is contractually locked. When you pay down principal on a 7% mortgage, you earn a guaranteed 7% return on that capital. Not approximately 7%, not an average of 7%. Precisely 7% with zero volatility, zero uncertainty, zero possibility of loss. Consider that carefully. A guaranteed 7% return in today's environment is genuinely exceptional. Most high-yield savings accounts pay 4 to 4.5%, 10-year Treasury bonds hover around 4.3%. Corporate bonds might yield 5.5% if you accept credit risk. A guaranteed 7% competes favorably with long-term stock market returns once you properly account for risk. There is another factor people consistently ignore. Taxes. When your investments appreciate, you eventually face capital gains taxes upon selling. Even with favorable long-term rates, that is still a meaningful portion of returns flowing to the government. But mortgage prepayment operates tax-free. You're never taxed on interest you avoid paying. That $145,000 in interest savings doesn't appear anywhere on your tax return. You simply keep it. This brings us to approach 3. The F-squared rule. The Freedom Fund rule. We've identified a genuine dilemma. Investing generates more total wealth, but carries significant risk and volatility. Prepaying delivers guaranteed returns and psychological comfort, but produces less total wealth. What is the resolution? The F-squared rule provides the answer. And it is elegantly simple. You pursue both simultaneously. I know. You wanted a definitive declaration of which strategy wins, but here is the uncomfortable truth. Personal finance is deeply personal. The mathematically optimal answer might be investing everything. But mathematical optimization doesn't capture how you'll actually feel and behave. Money transcends spreadsheets and formulas. It is about sleeping soundly. It is about managing stress. It is about the narrative you construct about your own life. Some people rest peacefully knowing their money grows in the market. Volatility be damned. Others cannot relax knowing they're buried under hundreds of thousands in debt, even if economists call it good debt. Neither group is wrong. They simply have different psychological relationships with money and risk. The F-squared rule prescribes splitting your extra capital between both objectives. The precise allocation depends on your individual circumstances, but here are useful frameworks. The 60-40 split directs 60% toward investments and 40% toward mortgage prepayment. This emphasizes wealth accumulation while still making substantial debt reduction progress. The 50-50 split, the balanced approach, half and half. You are simultaneously building wealth and eliminating debt. The age-based split. Younger individuals might allocate 70% investing and 30% prepayment. As retirement approaches, reverse it to 30% investing and 70% prepayment. The interest rate framework is my personal favorite because it lets mathematics provide genuine guidance. Here is how it works. If your mortgage rate exceeds 8%, prioritize prepayment. The guaranteed return is simply too attractive to ignore. If your rate falls below 4%, prioritize investing. The gap between your guaranteed rate and expected market returns is wide enough to justify accepting volatility. If your rate lands between 4 and 8%, which describes most current homeowners, pursue both. The exact proportions reflect your personal preferences. Let us model a 50-50 split using our $1,000 monthly surplus. You invest $500 monthly starting month 13, increasing 3% annually. You simultaneously prepay $500 monthly on your mortgage, also increasing 3% annually. With the prepayment portion, your mortgage disappears in approximately 21 years instead of 30. You avoid roughly $195,000 in interest, while spending about $118,000 extra. Your net savings equals approximately $77,000. With the investment portion, your 500 monthly contributions growing 3% annually compound to around $820,000 after 29 years at 8.5% returns. When your mortgage vanishes in month 252, you redirect your full mortgage payment plus the $500 you were already investing. That is roughly $3,827 monthly invested for the remaining 96 months. That grows to an additional $445,000. Your grand total $820,000 plus $445,000 plus $77,000 equals $1,342,000. That is genuinely solid. You accumulate $1.34 million, approximately $400,000 less than pure investing. But you also experience the psychological benefit of eliminating your mortgage 9 years early. You got to live mortgage-free while still young enough to appreciate that freedom. Certain situations make the math so compelling that prepayment clearly deserves priority over investing. High interest debt if you carry any loans above 10%. Credit cards, personal loans, certain auto loans, stop everything else and eliminate those immediately. You are not going to consistently outperform 18 or 24% credit card interest in the stock market. That math doesn't work. Approaching retirement, if you are within 10 years of retiring, a paid-off house dramatically reduces your required retirement income. You are not just eliminating principal and interest, you are also creating flexibility in your retirement budget and reducing financial stress during your most vulnerable years. Employment uncertainty, if your industry faces headwinds or your position feels unstable, reducing monthly obligations might prove more valuable than building paper wealth. You cannot make mortgage payments with unrealized brokerage gains. Psychological well-being, if carrying debt genuinely causes anxiety that affects your health and happiness, eliminate it. The psychological return of peace of mind might exceed any market returns. Conversely, certain situations suggest prioritizing investing. Low interest rates, if you refinance to 3 or 3.5% during 2020 or 2021, you essentially hold free money after inflation adjustment. Invest every surplus dollar. No emergency reserves. If you lack 6 to 12 months expenses in accessible cash, build that before prepaying anything. Liquidity saves lives. No retirement contributions if you are not capturing your employer's 401k match or funding your IRA. Do that first. Free employer money and tax advantages are too valuable to sacrifice youth and time horizon. If you are in your 20s or early 30s, compound interest becomes your greatest ally. The difference between starting at 25 versus 35 is genuinely massive. Time in market is your superpower. Time in market is your superpower. Here is what struck me while creating this content. The spreadsheet matters far less than I initially assumed. I spent hours constructing these models, verifying formulas, ensuring accuracy. The math matters. Absolutely, but it is not the answer. When someone walks into a newly purchased home, what crosses their mind? One person thinks, wow, they're succeeding at life. They own property. They've arrived. Another person views the identical house and thinks, wow, they've chained themselves to 30 years of debt servitude. That is basically financial prison. Same property, same mortgage, completely different narratives. The story you tell yourself matters more than any calculation I can demonstrate. Some people feel suffocated by debt. They cannot relax, cannot enjoy life, cannot sleep, knowing they owe $500,000. For these individuals, aggressively eliminating the mortgage isn't merely financially sound. It is psychologically essential. The mathematically optimal strategy of investing everything becomes worthless if it generates misery. Other people feel suffocated by illiquidity. They cannot tolerate having all their wealth trapped in home equity they cannot easily access. For them, investing provides flexibility. I am not a financial advisor, mortgage expert, or licensed financial professional. The content on this channel represents personal opinions only and is intended for educational and entertainment purposes. Please conduct your own research and seek professional guidance before making any major financial decisions. See you next time.